Hey everyone, welcome back to Corporate Decoder. Today we're diving into Infobird's latest annual report, and let me tell you, it's a bit of a roller coaster. Prepare for a tale of bold moves, shifting strategies, and a few financial twists that might leave you scratching your head. This report covers everything from company structure to risk factors, but we're honing in on the juicy bits, especially those financial tables. Infobird has been making some big moves, acquiring PureTech Global Limited in a two-step process. They bought 65% in November of last year and then scooped up another 32% in December. This acquisition seems to be a major shift in strategy, so it is important to dig in. It is important to understand that Infobird isn't your typical Chinese operating company. It's a holding company registered in the Cayman Islands, which means investors are buying into a Cayman Islands entity, not directly into Chinese operations. They're using what's called a variable interest entity, or VIE structure. This means they operate in China through contracts with companies they don't directly own. It's a way to navigate Chinese regulations, but it adds complexity and some risk to investors. Now there's also this thing called the Holding Foreign Companies Accountable Act. It's about making sure the company's accounting firm can be inspected by US regulators. If Infobird's auditor can't be inspected for 2 years in a row, their stock could get kicked off for Nasdaq. One of the biggest risks the report specifies is their reliance on these variable interest entity contracts, because they don't have actual ownership of key Chinese assets. This means if those contracts are deemed invalid by Chinese authorities, Infobird could be in serious trouble. That is one of the biggest red flags in this report. After the sale in August 2023, they talk about customer concentration, which is another potential issue to watch. They have a few major customers that contribute a large percentage of their revenue. So if they lose one of those big clients, it could hurt them financially. Now let's talk about those key financial numbers. Gross profit was at about 600k, but drilling into operating expenses, selling cost is around 400k and general admin is close to $2 for the year. A big chunk. It means it is costing them a lot to run the business. And let's talk about the big number. Their net loss was just over $2 for the year. Now that's not good. It was nearly 10x bigger last year, so at least the trend is improving. That still does not leave them in the green anytime soon. Their biggest use of cash in investing was related to putting cash in and out of escrow accounts, which indicates an M&A event. As they acquired a company this year, they made it clear by putting the cash for acquisition on the investing activities section. It's a complex financial picture with potential rewards, but very real risks. But the final number is in the end, they added over 4.5M to their cash balance, going from about 50k last year to almost $5M this year. That is real progress, but how? Well, it seems from this table they issued stocks and got about 5.7M from doing so and got another 4.2M of new funding. So while they still had a tough year operationally, at least they have cash in the bank to operate next year. And looking at the VIE structure, a big chunk of it's around $9 million, which is good in the Chinese operation of the company as well. So that has some value. They also mentioned there are other potential risks related to permissions from Cyberspace Administration of China or the sea, which might come to pass. Speaking of the Cyberspace Administration, the company is implementing security, like regularly conduct network security training for IT employees to provide employees with security awareness. They are also improving internal security by preparing a systematic policies and procedures manual for our IT processes in order to develop enhanced risk assessment procedures and controls related to changes in IT systems. Now, what do I take away from this filing seek? Well, the company is on a new course after selling off its original mainland China assets last year. This bold move might pay off if their new acquisitions, particularly PureTech, can bring the promised synergistic effects. In other words, improve their new strategy. Revenue needs to fix those internal control issues pronto, or it is going to be a big problem for them in the future. I would say it makes this company a little bit risky. The next 12 months is a critical period. So that's all for today's Corporate Decoder. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more deep dives into the world of finance.